This afternoon, I'm Damon Southward. Most of you know me as SCALP Trader. Two primary ways that I'm playing the energy space is via common units of MLPs and the preferred stock of MLPs. I've done some trades in drillers and oil services companies, but my goal is to build a portfolio of strong upstream MLPs that will provide both capital appreciation and double-digit distributions. I'm also finding a lot of opportunity in the preferred stocks of energy MLPs and drillers. Because of the uncertainty associated with whether these companies have sufficient funds to continue paying distributions on the preferreds, we're seeing a great deal of volatility. Also, because of generally poor liquidity in the preferreds, the selling pressure tends to be very severe. One of the reasons I like preferreds of MLPs is because the preferreds sit above the common units with respect to distributions, which means that in most cases a company can't pay a penny of distributions to common shareholders until all preferred payments have been met. In general, I found that there is not much investor-trader awareness of preferred stocks. Most trade on an exchange just like a stock, but have a unique ticker format that varies by broker. Companies will often have multiple series of preferred stocks. Here's an example of how Goodrich Petroleum Series C preferreds might be presented at various brokers. GDP is the root ticker. P or PR designates that it's a preferred stock, and C is the series. Memorial Production Partners is an example of a position I put on using the common versus preferred analysis. MEMP is an upstream MLP, which means Master Limited Partnership. They are tax-advantaged vehicles that require almost all earnings be paid out as distributions. An upstream MLP buys mature oil and natural gas assets that can be productive for many years. High-growth producers will often unload these assets so that they can focus on developing new fields. For example, a new field may yield 50 to 70% return on invested capital, while a mature field may yield just 12 to 18%. This is the perfect asset for an MLP structure, especially if the production is hedged. Unfortunately, most upstream MLPs fail to hedge things out for longer than 2 years, simply because of the lower prices they would have locked in the further out they went. Those prices seem absolutely fantastic in hindsight. With MEMP, I purchased the stock because of its best-in-class hedge portfolio that runs out to 2018. Most upstream MLPs were hedged aggressively through 2015, but then their hedges fall off dramatically after that. This is why the group has been hit so hard, with some stocks down 70% in 6 months. I also like MEMP because, unlike most of its peers, the company has maintained very strong liquidity of over $1 billion. As a result, when energy assets go onto the market for distressed prices, as many companies will have to sell because they need to pay down debt and have terrible hedges, MEMP will be able to buy them on the cheap and be positioned to take advantage of an eventual rebound in oil and nat gas prices. Vanguard Natural Resources is another upstream MLP. While the common stock was offering a plus 15% yield based on the company's hedges, I was pretty sure they would need to cut their distributions at some point. The preferreds offered a 11.5% yield and the potential for 42% capital appreciation to par. Based on the company's liquidity and hedges, I was pretty confident that it would continue to pay the preferred distribution. We purchased this on the site around 16.50 to 17. You see it's rebounded to approximately 22. A lot of the upstream MLPs have already been picked through on this leg of the trade. There are several that I've purchased and have already locked in 25 to 50% profits. Many of you have participated with me in these trades. I think the next opportunity will be in the common and the preferreds of companies that are forced to suspend their distributions due to bank covenants. When this occurs, the shares will fall dramatically. I think you'll see a lot of these units trading down to $1, $2 a share, and it will present a tremendous opportunity. I think this will provide a chance to participate in fantastic upside opportunities in companies that are only temporarily suspending the distribution until they are back in compliance with bank covenants. It may take 6 to 12 months before that trade begins to play out, but these may be securities that you have the opportunity to own for years to come that have potential for 300 to 700% in capital appreciation and 30 to 50% yields from the purchase price. I also will be keeping a close eye on the IPO market for energy companies that are formed with the specific purpose of purchasing distressed energy assets. Short term, I will continue to identify opportunities across the capital structure of the energy sector. As an example of the type of opportunity I continue to expect with preferred stocks, let's look at the recent performance of Magnum Hunter Preferred D. It has rallied from $20 to $35, a 75% advance in just a couple of weeks. At $20, this preferred yielded 20%. So I hope this has been somewhat helpful. A recorded version of this webinar will be available tomorrow. At this time, I'd like to answer any questions that you may have. And I'm going to switch over to the chat view. And if you have a question, please submit it into the chat. Someone asked about High Crush Partners MLP. Now, High Crush is a name that I've been involved in the past. With a lot of the Sandon MLPs, they have take-or-pay contracts. So they're multi-year contracts that require their customers to pay them even if they don't need the sand. The problem with some of these take-or-pay contracts is that if the customer doesn't take the sand, they pay them a lower rate. And there's been some question about just how strong these contracts may be. I know that was on a conference call recently, and one of the major players in the space indicated that they didn't really expect to hold their customers to their contracts. And this was a pretty large player. So I think there's going to be some uncertainty in that space with respect to how strong those contracts end up being. When it says MEMP and VNR are basically done now, which other opportunities do you see now? Well, I think now requires a little patience. And you've seen a major uptick in a lot of these energy MLPs, just energy-related stocks over the past week to 2 weeks. As crude oil starts to come back in, and we're still anticipating another major sell-off in crude oil, you'll see another leg down in a lot of these stocks. And I think that in end of January, April, May, when a lot of these companies have their revolvers reviewed by their banks, and their banks implement a lower price deck for commodity prices, they will see their credit lines cut, and it's going to create a liquidity crisis for a number of these companies. And that's where that preferred trade is going to come in. Because some of these companies will literally have a few $1 million in the bank and have a very difficult time raising capital in order to fund their drilling needs or any type of maintenance needs. So at this time, I'm not aggressively buying anything. Or I think last week we put on some CVEO as well as some SSE and had some nice returns in those. Right now, basically taking profits and things and waiting for them to pull back. Someone asked, do I basically agree with the idea that MEMP is done now? We purchased MEMP, I think we're probably up about 25% on MEMP. And I purchased it as not only a yield play, I think we purchased it around a 17 to 17.5% distribution yield, but also a growth play. MEMP is one of the few upstream MLPs with strong liquidity, over $1 billion. So they're going to be a prime player to be able to take advantage of distressed asset sales. As I listen to conference calls every day, most of the drillers and upstream MLPs that I listen to are very challenged with liquidity, and they're aggressively marketing assets. And some of these assets, especially the natural gas prices continue to fall, oil prices continue to fall, it's just a matter of time before you start to see some deals actually take place. Right now, buyers and sellers are quite a distance apart. But I think a company like MEMP will be able to buy assets at a 15 to 20% return on equity and go in and lock in those hedges right away. So they're buying them down here with double-digit returns. And as natural gas and oil prices rebound in the years ahead, those returns become even more favorable, which would allow them to build their distribution growth. And just reviewing some of the additional questions. Someone's asking about coal. Not a space that I follow that closely. That would be more of a question for commodities trader. But there are a lot of coal companies that fall into the distressed category. However, just given the pension liabilities of so many of these companies and the fact that coal assets tend not to do very well in distressed sales, I tend to stay away from coal plays. So I think someone asked about which other companies am I looking at. Now, I think one of the more levered plays on a rebound in crude oil prices are the services companies. Every day that I listen to conference calls, the producers or drillers are basically saying, we're expecting a 15 to 30% reduction in our costs from the services companies. So they're being pretty aggressive, literally shutting down drilling until the services companies come back with lower prices. Given there's so many crews out there and so much capital equipment sitting around waiting to do business, I think with a bounce in crude, you could see potentially a shortage of equipment and crews as crews get laid off, and which could give the services companies tremendous pricing power. So I think that you probably want to be patient and wait for a significant rebound in crude oil to start buying the services companies, but they're trading at such distressed levels that you could see quickly a 50 to 60% return on the common stock. But the bonds on some of these are really interesting as well. I mean, I was looking at a couple of names earlier this week, and the bonds are trading at 45 to 50 cents on the dollar. And I think that could be a really interesting opportunity if you see a significant bounce in crude oil prices. Someone asked about LGCY. I think they have another distribution cut coming. If that occurs, I'm hoping the preferred stock will get hit, and we'll be able to step in and buy that at an attractive level. Okay, so I'm going to take one more. Someone asked, so for any income opportunities, would you want to wait for another pullback? That's what I'm doing. We've purchased some names. MEMP, I haven't sold any. I want to continue to build a position there. With some of these other names, we've been able to pick up profits of 20% to up to 50%, and we've been scaling out along the way. I think that we're probably in maybe the third inning of this ball game. We're not at the point yet where revolvers, credit lines have been cut dramatically. We're not at the point yet where companies have literally just run out of cash, and that's going to occur. So, I think that we're early stages, and there's still going to be a lot of volatility opportunities in this energy space. So I think it's really important to stay on top of the news events that occur, especially in the next couple of months as these revolvers and credit lines come under review. Because if they get slashed significantly, literally companies that thought they had $300 million in liquidity may go to $10 million in liquidity, $50 million in liquidity, which might not allow them to make it through the year. Their bonds will get hit, their preferreds will get hit, and it's just a matter of picking through and trying to find the ones that actually make sense. Okay, so we're going to end it there. Thank you for the questions and for participating. I intentionally want to keep this short. I know that people get intimidated by long webinars, so for everyone who wants to review this at another time, won't take up a significant portion of your day. And again, if you have any questions about anything that we've discussed or any additional questions that you'd like to ask, feel free to email me at briefingtrader@briefing.com, and I'll be happy to answer your questions. And yes, the webinar will be recorded. It will be available tomorrow, and we'll post a link on the site. Okay, well, thanks very much for joining me. And again, feel free to ask me any questions. Send them to briefingtrader@briefing.com or through the Talk to Us feature on the in-play page. Thank you.